Welcome. Let's take a look at an exercise where a company issues bonds, and with this bond, they're also issuing detachable stock warrants. Stock warrants simply mean that the company is giving the right to the investor, the person who's buying the bonds, to purchase stocks in the future at a predetermined price. So right now, I tell you, you can buy stocks in the future at price X. Obviously, in the future, you hope that the price of the stocks is higher than X. You can buy my stocks at X and then turn around and sell it immediately for a gain, or hang on to it if you think the value is going to go up. So in this exercise, we'll take a look at the company that's issuing the stocks and a company that's buying the stocks. So let's first start out by reading the information given and start with the company that's issuing the stocks. On August 1st, 2024, Perez Communications issued $30 million 10% non-convertible bonds at 104. It means they got 4% more than the face value of the bonds on August 1st, 2024. That's just one piece of the puzzle that we have here. Let's look at all the other pieces of information. The bonds are due on July 31st, 2044. That's their 20-year bonds. Each $1,000 bond was issued with 20 detachable stock warrants, each of which is entitling the bondholder to purchase for $60 one share. So I'm giving them 20 stock warrants, but that will give them the right to purchase one share, and the predetermined price is $60. Interstate Containers purchases 20% of the bond issue. This is the investor. We'll get to them in a second. On August 1st, 2024, the market value of the shares is $58. I don't care about that right now. The next one is important. The market value of each stock warrant is $8. So these bondholders could have just bought the stock warrants from outside for $8. I'm going to record the stock warrants and we'll see how we make use of this information. Feb 2035, Perez common stock are trading at $72 per share. Unamortized discount is 1 million, and Interstate Containers exercise the warrants it held. So lots of information over here. Let's first worry about issuing the stocks. So on August 1st, 2024, Perez is issuing the stocks. This is in the books of the issuer. What we know for sure is they're getting cash. So it's going to be cash debit. We also know how much cash they're going to get. They sold it at 104. They asked for 30 million, which means they're going to get 30 million times 104%. So the cash they're going to get is $31,200,000. I know that. I'm going to leave the next two lines and then move on to the third line. What I also know is the bond value, the bond issue, the bond face value of the bonds. Remember, a liability, we always have it at face value. This is given in the problem. I know it's $30 million. So these two are fairly easy. That first sentence said, I'm issuing $30 million bonds. They're non-convertible. 10% is the interest rate. I'm issuing it at 104. Cash debit, 31,200,000. Bond payable credit, 30 million. This part, the very opening sentence, gives us that information. Now, what else did I give or commit to at this point of time? These stock warrants. Okay. What I've committed to is the equity. I'm going to give out equity, so equity stock warrants. Now, how many stock warrants did I issue? And what is the market value at the time of issue? That's what I'm concerned with. Okay, so how many did I issue? Let's first answer that question. $30 million in bonds were issued. Each bond has a face value of $1,000. 20 detachable stock warrants are given to each bondholder. So let me scroll down over here. I have $30 million over here. That's the face value of the bonds that I issued. Each single bond is $1,000, which means the number of bonds I sold is 30 million divided by 1,000, and that gives me 30,000. So I sold 30,000 bonds. The bond instrument, I sold 30,000 of those, each with a face value of 1,000. That gives you that 30 million. Now, I also know that on this day, each bond carried 20 stocks, which means I basically gave one bond, gave 20 stocks. So the number of stock warrants that are issued is 30,000 bonds times 20 will give you the 600,000 stock warrants that are issued. At the time they are issued, they're selling for $8 a piece in the market. So those are the numbers I'm concerned with. These two numbers, let me highlight it over here for you. I gave out 600,000 stock warrants. If I had not given it to these bondholders, I could have sold it in the market for $8. Okay, so that is what I will I will record my stock warrants. 600,000 stock warrants, we know where we got that number, multiplied by 8, and that gives me 4.8 million. When you started out looking at the first sentence, it looked like you issued the stocks at a premium. But when you see that I gave these stock warrants the rights for someone to buy my stocks. What I could have got in the open market, 4.8 million, I gave it to these guys. Now, when you see the balancing figure, it's on the debit side, which means this is actually a bond discount on bonds payable. So this is my balancing figure over here in the journal entry. So once again, I know cash debit, bond payable credit. That part is easy. I had to calculate how many stock warrants I gave out and what is the market value of the stock warrants at the time of issue. That's the number I'm looking for over here. Now let's take a look at the same date. There's another party out there, obviously. They're all those buyers. So we have interstate containers that purchased 20% of the bond issue. So let me move up over here. Now, what you're looking at over here, you will have the mirror image of that journal entry, but from the viewpoint of the investor. So the investor purchased 20% of this investment, 20% is what they bought. Again, if the company sold 30,000 bonds, this particular investor is purchasing 20% of that is 6,000. Each bond is going to carry 20. So this is going to be, they got 120,000 of the stock warrants. This company received cash, which means this company gave out cash. They paid out cash. Okay, so cash credit. Of this money, 20% is a number that they gave out. So you can just take this number, the cash number that you have over here. Let's put it in a decent color that we can see. Over here. Okay, so 31.2 million multiplied by 20%, and that's the number that you will see over here. It has to be exactly a mirror image over here, okay? Now, this company is recording a liability. So what will this company record? The opposite, an asset, okay? They will call it investment in bonds. For them, it's bonds payable. For them, it's an investment in bonds. $30 million, 20% of that is their investment. So face value times 20%. So face value of the bonds, this 30 million times 20% because they bought 20% of the issue. Now, this company recorded yet another item, equity, stock warrants. For this company over here, again, it's an investment. Okay, so it's an investment in stock warrants. What's equity over here is an investment for me over here. Again, it's exactly 20% of this number is what I will have over here in my books. So of the 600,000 warrants, 20% of those are mine, and I paid $8. Or you can just take this number that's there, 4.8 million, and 20% of that is 960,000. Discount on bonds payable, both call it the same name. Okay, discount on investment, discount on bonds payable, both call it a discount. And this is the balancing figure in your journal entry. Just like it's a balancing figure over here, it's a balancing figure over here. So you could take all these numbers, flip the debits and credits, take 20% of those, Since you've already done the calculation once, you know it's exactly 20% over here. What's a liability over here is an investment. It's an asset over here. Again, what's equity over here is an investment. It's an asset over here. Cash debit, here they have cash credit. Both call it a discount. They call it a discount on bonds payable. We call it a discount on investment. So that's at the time of issue. Let's go back to the exercise and see what else is told to us later. In Feb 2035, when Perez common stock has a market value of 72, an unamortized discount of 1 million, Interstate Containers, that's this one investor, exercises the warrants that they have. Now, they've given us 3 pieces of information. Feb 2035, they're telling us 3 pieces of information. First one is market price is 72 per share. We don't care about the 72 per share because it's a predetermined price that they're going to buy it at, and that's 60. Their exercise price is 60. So 72 is just extra information. Obviously, 72 is more than the 60, which is why they're exercising it. Otherwise, why would they exercise it? Unamortized discount is $1 million. Nothing happens to the bonds. The bonds continue to stay in the books. So this unamortized of $1 million is just extra information. We don't need it for the exercise. What we do need to know is that Interstate Containers exercises the warrants they held. That's the only thing I really need over here. I have this one investor with 20% of the stock warrants. They're going to exercise all of it. Okay. So what's going to happen over here? This account that we have over here, let's put this in a different color, the equity stock warrants, they are trading that. They're saying, we don't want that. We want to buy the stocks of the company. They're going to pay us cash, and they're saying we don't want these stock warrants. So stock warrants that we had credited, stock warrants we are going to debit because it's going to come off our books. Okay. And we are going to give them stocks in the company. We're going to give them stocks in the company. So let's do this. They had 120,000 stock warrants. All of these stock warrants, they purchased 6,000 bonds. Remember, that's going to give them 6,000 shares. Okay. So 6,000 bonds, they're going to get 6,000 shares. Let's see how we'll do all the calculation. 600,000 warrants times 20% gives you that 120,000. They're going to pay $60. That's 7.2. Remember, $60 is a predetermined price. Okay. The stock warrants, again, we could just take the full number and multiply that by 20%. That's the easiest way to go doing the calculation. Sorry, up here. And then common stock is a balancing figure. Okay. Or you could do 68 times the number of common stocks you're issuing. Either way, you're going to come up with the same answer. Now, in the books of the buyer, they have investment in stock warrants. Here it was equity stock warrants. Here they have investment in stock warrants. That same account, they're going to give it up and they're paying cash. So investment in stock warrants is going to go away from their books. What are they getting in exchange? They're getting the common shares of that other company. Okay, so they will debit investment in stocks because that's what they're getting. They're paying cash and they're giving up these investment in stock warrants. So this entire $960,000, they're going to take it off their books. How much cash are they paying? Well, exactly the cash that this company got is what they pay because they are the ones who are paying it. That's 7.2 million. So their investment in stocks is 8.16. Let's try this another way over here. Let's see if we can do this calculation. We can take these numbers that we have over here. Again, 120,000. Let me write this down over here. 120,000. Let me put this. 120,000 times 60. And this is going to give you how much cash is paid. The implicit price, what we had already paid at the time of purchase, was $8. Okay, so again, the same 120,000 times 8. Okay, let me drag the font here. When you add these two numbers, you will come up with this 8.16 million. So at the time of the purchase of the bonds, the implicit purchase price there was $8, and now they're paying, and they had purchased the stock warrants. They received the stock warrant saying you can buy it at $60. So they technically really paid $68 for those shares. They really paid $68 for those shares. So the investment they're going to put down is at that $68 because that's what the true purchase price is for them. So once again, in this exercise, what we've seen is a company wants to sweeten the pot when they're selling the shares. They're offering these shares and saying the bonds, they're offering the bonds with another item. The other item they're selling is a right to purchase common stock in the future at a predetermined price. Once again, if you look at the exercise, on the day that I sold my bonds, the market value of the stock is 58. I'm telling you to buy this, and I'll give you my bonds, and I'll give you the right to purchase the stock at 60. Why would you agree to 60 if the market value is only 58 today? Obviously, you agree because you think in the future the value will go up, which it did in fact go up to 72, and I can buy it at 60. So this company will still come out ahead, the investor, because they paid 68. 8 plus 60, 68 is what they paid, and they're selling for, if they buy at 70, when the market value is 72, they can still come out ahead with a profit of 4 if they sell it today. But obviously, they believe it's going to go up in future, so we're good. Now, again, just keep in mind this information given to you over here. Market value is 72. It does not affect our journal entries. The issuer or the investor, it doesn't affect them. The unamortized discount, it stays in the books because the bonds are still there. The bonds have not been paid off. Only if the bonds are paid off early will this discount be, the unamortized discount be taken off your books. Otherwise, nothing is going to change. So once again, go through the exercise and see if it makes sense, and make sure you send me a message if you have any questions.